Welcome everybody to our Leaders in Housing Counseling call for February 16th. So we'll do our usual quick summary on policy issues that are happening in the Hill or in DC, and as probably you get to read a lot of it in the newspaper, so we'll be as quick as we can on how these apply to the housing counseling world and our work. But we'll spend most of the call talking about the foreclosure world now that HAMP has gone away, and getting a very early read on what we're seeing. I know that it's very early, and a lot of people have said that to us, but in fact I think we're beginning to see some hints of what things might look like, and getting these early indicators are a really good way of knowing what to look out for and where we may need to. We're having regulators already asking us, so this will be a starting of the conversation, and there'll be plenty more through the year. I think this will be helpful to us, though, in being able to shape the debate some more. And then we, as you all know, we had done a study that many of you participated in. There's FlexMod, which is the program that Fannie Mae and Freddie Mac have for doing modification using a streamlined methodology, extending for 40 years. And we took a bunch of cases and looked at that were people who got affordability mods, either HAMP or non-HAMP in the past, and we got Freddie basically to run through, working with FHFA to run them through the machine. So we're going to have some results from that, and Ellie Pepper and I will run through those. Ellie, of course, is with Empire Justice Center, and the study was done with NCLR and Empire Justice Center and us. So, and then we'll close out with a quick membership plug, and but I think we'll have a full hour. We're very interested in what you think, and especially what you're seeing or not seeing in the field around the delinquency and default counseling work that we're working with servicers on. So all of this is meant to be really a very first investigation on what the status of things are. So Matthew, let's get started with what's happening on the Hill.
All right, so we'll just quickly kind of run through some of the nominations that are relevant to folks. Hopefully the screen is moving. I'll have to figure it out if it's not, but we'll quickly run through this first. So for the Office of Management and Budget, Mick Mulvaney, who was previously Congressman from South Carolina, was confirmed this morning. It was a 51-49 vote with, it was a party line vote, with John McCain being the one Republican who split off and voted with the Democrats. Folks may or may not be super aware of OMB, the Office of Management and Budget, what they do, but essentially the biggest responsibility that Mulvaney will have is writing the administration's budget. So, you know, the administration gives their policy priorities, but they're the ones that actually put it into, you know, this massive document that goes to Congress and outlines what the administration is requesting for funding. So Mulvaney is really best known for being a deficit hawk. The reason that McCain voted against him is that he in the past has even been an advocate of cutting defense spending in addition to cutting domestic spending. So that is Mulvaney. Just to quickly touch on, so how so Mulvaney will be working on the administration's, what they're calling first a skinny budget, which is expected in February, March. It's unclear exactly how skinny it's going to be, but it's basically just going to be an outline for FY 2018, and then later in the spring, it will be they'll do the the full actual budget. Just wanted to quickly mention that it's looking increasingly likely that for FY 2017 that they have this massive legislative agenda that they're having trouble even getting that going. So it seems very likely that that there's going to be a continuing resolution for FY 2017, and there's even starting to be rumors from folks on the Hill that in the appropriation circles that they're going to end up doing a continuing resolution for 2018 as well, just because they have this huge legislative agenda that's they're going to have their hands full with that they're not going to be able to do appropriations bills. And then just quickly also to mention that Steve Mnuchin was also confirmed as the Treasury Secretary. I think folks have probably heard his name by now. He was what folks dubbed as the foreclosure king of California because of his role in One West, which was really a leader in foreclosures. And there were very serious accusations of them cutting corners with foreclosures. There were a lot of concerns about his role at One West and what One West did. His was a 53-47 vote. Joe Manchin from West Virginia, a Democrat, joined the Republicans in voting for him. Just did want to mention there was a lot of great work that was done, particularly by the California Reinvestment Coalition and a lot of other groups that did a great job of getting the word out about One West and Mnuchin's role there. It was clear that the Democrats were not going to have the votes. They need 3 to stop any of these confirmations. They need 3 Republicans to join them, and they were not going to peel off Republicans on that vote. But I think they did do a great job of getting the word out and making sure folks understood who Mnuchin was, who he is, and what to expect from him as Treasury Secretary. I will also, and I apologize, I'm not sure what's going on with the slides, but I will try to figure that out when we wrap this up. Just also wanted to mention, we had talked on the last call about a bill that the House of Representatives was considering. They marked up and now it passed out of committee that would essentially prohibit settlement agreements between the Justice Department from including funding for third parties. So essentially what it targets is agreements like the Bank of America and Citibank settlements that included funding for HUD-approved housing counseling agencies. Provisions like that would not be, Justice would not be able to include agreements like that in future settlements. Passed out of committee. It's unclear when it's going to go to the House floor, but also it would not have the votes in the Senate. So just kind of keeping that on people's radars. And then just the last thing to quickly mention, this is not Hill related, but so the HVP case that folks may have been following, we've brought it up on the call. This has to do with RESPA and the prohibition in, or the CFPB's reading of RESPA that that could have been applied to prohibit agreements from lenders and housing counseling agencies, that those could have been prohibited as kickbacks. So the concern, CFPB didn't specifically read it that way, but they're reading in a separate context, could have been understood as applying to housing counseling agencies. We've been working with CFPB to try to get some resolution to that. But the case had been, basically CFPB had lost on constitutional grounds at the circuit court level, had applied, and that ruling would have found that the director, the single director structure, independent, that couldn't be fired for cause, was unconstitutional. The entire circuit court has agreed to rehear that case. So there's a chance that the ruling that the CFPB's structure is unconstitutional could be reversed. There's also some statutory questions as well. Bruce asked me not to get too far into the weeds on that one. I did not succeed on that, but if folks have questions, I'm happy to take those offline. And I'm going to try to figure out what's going on with the slides now.
Are you there, Bruce?
Oh, I'm sorry, I was on mute. And sorry about that. So thank you for saying that, Linda, for jumping in. I thought I was just chattering away as everything was good. So just a quick thing on what Matthew was saying on the CFPB. That's the PHH lawsuit is the one that would knock the CFPB director out and allow him to be replaced. And so that issue is an important one, and obviously the RESPA issue as well. Some banks have hesitated doing fee-for-service relationships without having the RESPA issues more clearly defined, so that it's not they're not worried about it being a RESPA problem. Certainly, some lenders are moving forward on doing fee-for-service without being concerned about that problem, but it's been a problem for others, and so we're working with a coalition of housing counseling groups to really perform on improving the on getting a much cleaner definition so that we don't have problems with RESPA and fee-for-service work. But we're still in the middle of all that. So let's move on. And so we've gotten one slide. Let's move to the next slide to see how that's working. There we go. Okay, cool. Okay, so our world has changed a lot with HAMP going away. And as I said at the beginning of the call, we understand this is completely at the very beginning of all this, but this is where you get early signals of what's happening in the field that we can help figure out if there are going to be problems and where there are successes and strengths. And so we've gotten a few reports, and we've gotten a few questions from regulators. And so the idea was, let's get an early read of what people are seeing in the field. So we've got a panel. Not quite everybody on the panel is actually able to join us for the call today, but we'll have a good showing, and there'll be room for people to write in and give us their experiences as well. And we're definitely interested in figuring out where there are early problems. But this is the whole idea is, yeah, we understand that FlexMod is not in place yet. That not every, even when it starts in March, not every servicer will start with it, and some will not be up to speed. But we're very interested in just what early things people are hearing. What are they hearing on other modification models? Are they how is it getting? How are the paperwork and submissions being handled? And are there new kinds of mods that we haven't seen before? And so let's start in. So we have Frida Williams, a very deeply experienced person from the Home Free USA network, and Frida has also checked in with her staff as well. So Frida, what are you seeing in the field? Welcome.
Some of the things, hi Bruce and everyone else on the phone. Some of the things that we're seeing in the field is the lenders are pushing out the denials and or approvals for loans that are being looked at under the Making Home Affordable after the deadline. We haven't gotten too many new modifications yet, but something interesting did occur where we've seen where FHA loans that have gone into default were being transferred to different lenders, and then those lenders coming back and asking those clients to do a modification under a conventional structure, increasing the term, making it a conventional loan, and as well a step modification. We've gotten quite a few denials without explanations. We've gotten quite a few rejections only to find out that they're no longer wanting to accept the Making Home Affordable applications and or the 710, and they're requesting you fill out their own paperwork. So it seems to be that we may be going back to where we started at in the beginning in terms of a lot of back and forth on how to submit the documents without just coming straight out saying, you know, we want to just basically have you submit all your documents through this portal and or submit them or come out with a standard application for submitting a hardship packet.
So we were trying to get servicers to use the UBAF, the Fannie and Freddie form as the model. So is that happening, or are they going back to their own proprietary ones?
Some are going back to their own proprietary application.
And are you seeing an increase or a decrease in the amount of documentation that's required?
Same amount of documentation is being required.
Interesting. So
I am seeing quite a few streamlines as well, where they're just being done and sent to the borrowers, and the borrowers haven't submitted documentation.
So that's interesting, and I take it it's at the 90-day threshold?
It's
we know
they're more delinquent than 90 days.
Oh, okay. And what do those, are those all 40-year term extensions?
No, they're not.
Oh, so
some have been 30, some have been 30, some have been 40, and some have been just on the remaining balance, the remaining term.
Oh, that's a good one. Okay, interesting. Well, that's great. And,
I am seeing FHA as well, looking at doing larger deferments on their principal balances in order to get them done. So that's a good thing.
Well, that is. FHA has been such a difficult resolution. And are there particular services that are doing that, or is that across the board?
Well, I want to say it's across the board because we've had it done twice now. So it's not the same service every time. So I'm just hoping that it continues, because I was really surprised by the amount of a deferment that was given for the client, and the fact that even though the rate went up, it still made it more affordable for the client because there was such a large deferment.
Interesting. Okay, so let's see, Linda. We have Linda here from Beyond Housing, who's an NHRC board member and longtime veteran of the foreclosure prevention work. So what are you seeing?
Thank you for not saying old. Thank you for not saying old. Long time I prefer. That's great. Hi, everyone. I'm with Beyond Housing in St. Louis. We're a community development organization. We focus a lot of our work in a specific school district, but the foreclosure intervention services have always been regional. So we participate in mediation across the river from St. Louis and Illinois. Illinois is judicial, Missouri's non-judicial. We're seeing really new challenges and changes that Alfreda said that it seems to be that we're moving back to the way it was in the beginning. And having done this in the beginning, it hits me when we get the pushback and the problems that we had in the very beginning. You know, without HAMP being a kind of a standardized way of submitting documents, and as housing counselors, we have our expectations about if we do this, then this should be the result. We don't have that anymore. It kind of adds to the chaos that I think a lot of people are feeling in lots of different areas. So, you know, we were hoping that instead of an RMA, we would move to the UBAF or 710, and we really have not seen that happening. Another problem that we've had is that we have an authorization that literally has not been changed since we started doing this in like 2008, 2009. And yet it's being rejected in favor of a servicer's own authorization for us to speak to them on behalf of the client. So that's an obstacle. It's not a big thing, but once all these little things start happening, then it really adds more work for the counselor and more uncertainty as to, we think we know what we're doing, we've done it so long, and suddenly it's not the way it used to be. It's kind of a learning curve, discovering what different servicers want. So we've started keeping files of the packets that certain servicers require. So we still have our own process where we request documents from the homeowner prior to coming in here. We know basically no matter what form the servicer has, we're going to need the pay stubs, the bank statements, the hardship letter. So we're trying to stay focused on what we've done and what works for us, and then adapt to the different things that are being thrown our way. Our volume has increased, so that's probably for several reasons. We have seen very, very delinquent loans that are finally, the homeowners are getting foreclosure letters. So I don't know if there's a sense of cleaning up the old or not. That's just kind of what we're seeing. We are seeing FHA loans that have been sold, and so now they're conventional loans, so that kind of throws things off. We are working with homeowners since the beginning of the year, so it's kind of different to see what they're getting. We don't have a lot of cases that have been resolved yet, but I did get one this week that I thought would be interesting to share. These homeowners have owned their home since 2004. Their payment was $1,600 a month, and they could no longer afford that. And so we were working with Ocwen, and Ocwen wants their packet, but as long as we know that, you know, we can deal with that. And these homeowners received a trial modification of just one payment. I kept looking at this and reading it and thinking, what I must be missing the other two payments, because we're kind of used to, you know, kind of a minimum of 3. This is one trial payment, and then the permanent modification paperwork was included with this trial. They received an interest rate of 2% for the entire loan, and their payment was cut in half. Now, in 20 years, they have a $71,000 balloon payment. But that just looked different to me than what we're used to seeing. One thing I would like to see, and maybe we can do it through NHRC, is to have an updated escalation list. We try to work with the servicers. A couple of them, we have a biweekly call. We have a biweekly call with Wells Fargo and a biweekly call with U.S. Bank. And it's very helpful because you have an opportunity to articulate the questions and the issues that we're having, and it seems to move the files along faster. So I want to do that with more of the servicers, those who are willing. So I'd like to see us maybe work on that. So that's kind of what I have.
Excellent. That's certainly a good idea about, well, I guess there's 2 ideas there. One is improving the escalation lists and updating them. I think we have a few updates on the list that we've got, but it's probably could stand to be refreshed. And the second one is to increase the number of conference calls that you have with servicers that are really dealing with getting cases resolved. So who are the most common servicers that you see, Linda?
Ocwen, Ditech, NationStar. We haven't seen many Bank of America, but we have gotten a couple. Chase has popped back into view. We went for a while without seeing them, and we have a lot of U.S. Bank because I guess U.S. Bank has done a lot of lending in our area, you know.
Right, regional.
But I had a case with Ditech that literally there was a foreclosure and it would not have worked out for the homeowner, but I had a contact at Ditech. So we're in this age of, you know, submitting things online and hope loan port, but you know what? It's the real world, and sometimes you need to get a hold of a person who's willing to take the extra step to make these things work out. And we're particularly under the gun in Missouri because we're non-judicial, so we don't have a lot of time to go back and forth. We really need to find somebody who's going to be a good partner and work through some of these issues.
Very helpful. Everybody stay on the line here. We're going to have some opportunities for discussion as well. So we also have Emma Cordova from the East LA Community Corporation, organization which had a deep, long history in both pre-purchase and in the delinquency counseling. Emma, are you on the line? Emma, can you hear us? Okay, well, let's move on to Ellie Pepper. And if Emma can come back on, let us know. So Ellie, I know you've done some talking in your network. So what have you seen?
So the first and foremost thing, hi everybody, first of all. The first and foremost thing that I'm hearing is people aren't really seeing new modifications yet. They're still kind of working through the people who managed to get modification applications into HAMP before the end of the year and kind of working through that process. But some similar things to what other people have said, seeing the 5-year interest-only type modification offers, and seeing the non-specific denials, and then also pretty much just kind of waiting to find out what is going to get offered, submitting paperwork and waiting to see what's going to get offered. So that's kind of what I've been hearing from folks.
Okay, so say more about the non-specific denials. What's that?
So again, it's just a denial without a specific reason for a denial. Just, we denied your application. So sending, specifically sending something in writing. And I want to ask Elfrida the question about that from her folks, but specifically sending something in writing, but that doesn't have a specific denial, just says denial. And what I'll say about that is the CFPB servicing regulation makes it pretty clear that number one, a denial has to be in writing, and number two, that denial has to be specific. And it can't just be, you don't meet our guidelines. It has to be specifically what guideline is it that isn't met. And so the other thing I was wondering from Elfrida is if her denials are all in writing or if some of them are over the phone. And if they're over the phone, that's specifically egregious. And if they're not specific, complaints should be getting filed to the CFPB about these issues so that CFPB can look into it.
And we do have this kind of hotline red alert piece too. So you should you should do a complaint, but also there's that special information line that
the servicing tips.
Yeah, servicing tips.
The servicing tips, is that what you're talking about? Yeah.
Yeah, right. So that goes straight to the enforcement people. So it's really helpful to do both at the same time.
Yeah, and the other thing I'll say, I wanted to comment on the FHA to conventional. Linda mentioned that those were ones that were sold in those distressed asset sales, and I'm wondering if that's what Elfrida is seeing as well, are loans that went to conventional because they were sold in a distressed asset sale, so they no longer are eligible for the FHA. Yeah, that's particularly frustrating, isn't it? Yeah. So the other thing related to the escalation contact list that you mentioned, Linda, in this was a couple of years ago, the CFPB put out their mortgage servicing examination manual, and at procedure 17 in the supervisory highlights, CFPB said that they will be determining whether a servicer has an adequate process to identify and escalate requests for information, notices of error, or complaints that may involve regulatory compliance issues, and when the borrower is facing imminent foreclosure, determine whether the servicer has an adequate process for expedited evaluation and resolution of requests for information, notices of error, or complaints that may involve regulatory compliance issues, and such an adequate process could include a dedicated phone line that connects directly to a live representative or another path for borrowers or borrower advocates to resolve identified regulatory compliance issues in advance of an imminent foreclosure. So they were very specific about that in this supervisory highlight, and that was as a result, you should know, as of Bruce and folks from other national organizations advocating. This was led by Ruth Susswine from Consumer Action, and of trying to get an escalation line at CFPB, and they just did not have the staffing available. So this is how they addressed it. So again, if a servicer does not have an escalation line, there should be a complaint filed about that, because it is something that they are to make available.
And we have to have access to. Well said. Elfrida, were you going to say something? And then I've got some more to add too.
Well, I just wanted to say that some of the denials have been coming through the Hope Loan portal from the servicers to the counselors or homeownership advisors, and they're just saying file denied. And they are mailing out letters to the clients, but they're providing the counselors with very limited information. And we're having to call back in and maybe challenge them on some things and the way that they're looking at income or viewing the files. So clearly we are aware of, you know, what's required. So we do follow up with that to make sure that that's happening. And yes, they are a lot of FHA loans that's being sold off as bad assets, converting over to conventional loans. And it's an issue sometimes because it's of a benefit to the client, and sometimes it's not of a benefit to the client. And it's even affecting clients that are previously have filed bankruptcy, you know, where they're being offered modifications even after they've done Chapter 7s. So,
and the denial letter that goes to the homeowner, is that specific or is that missing information?
it's the majority that I've seen has been specific, but it's still language that a typical homeowner would not understand.
Oh, you hate that, don't you? I mean, it's worth elevating anything we can like that to the CFPB to see if there's a possibility of an enforcement action or something like that. I mean, I think what we're seeing some is just sort of slippage outside of the HAMP world that is, so this is all very valuable.
Bruce, we can escalate. We always escalate to HUD Servicing Center in Oklahoma City for any FHA loan that we have any question about. They've always been, you know, active, and they always contact the servicer. And then just within the last couple of months, I've contacted Fannie Mae too, just to, you know, get their input on you know, what we can do next, or if they think that what's happening is correct when it's one of their loans. So
right.
Good. One more quick thing that it looks like Sergio from Montebello Housing wasn't able to join us on the call, but he had raised that they have seen they got an NPV denial, and the NPV denial did not have the usual input data that's there. It was simply said denied for NPV reasons. And you know, I think, and I'm not sure where that fits in the CFPB servicing standards. I mean, it sounds like that might be more of a HAMP requirement. Do you know off the top of your head, Ellie?
I don't know. I don't, but I can take a minute to look in my servicing handbook quickly.
Well, I mean, you know, at whatever point, I mean, we should just figure that out. But this may also be just the loss of, there's so many things we'll lose because HAMP is over. This may be one of those as well. And obviously, if the NPV numbers are crazy and don't well represent what the property is, that was the place that people could go back to.
Bruce, so, I don't know if anybody else has the kind of feeling that I do about not having the support of knowing that there is a program called HAMP and that there are specific rules. I know we have the CFPB, but it's not really the same, because I always felt like we had the backing of treasury and the administration and all when you're talking about HAMP, and we don't have that anymore, and that is a real loss.
Yep, that sums it up. Wish we could say something positive on that count, but we can't. So
Right.
Matthew, we got some questions in or comments?
Yep, we have questions and comments. So someone says, ShellPoint told one of my counselors that they accidentally deleted HAMP calculations from their system, and she went on to say this is a file that was submitted prior to 12/31/2016.
Ooh, what was the name of the servicer?
ShellPoint.
Okay, don't know them. Yeah, yeah.
Someone asked, it's kind of a question and a comment, is anyone having issues with lenders closing HOPE loan port cases faster than normal since HAMP ended? And then they said it's a lot of time spent by the counselor to have the file immediately closed.
We've had that to happen a lot as well, and from what we're being told is because the files should not be submitted under loss mitigation anymore. They need to be submitted under home retention, so other files are having to be reopened under home retention.
Is that Wells Fargo?
No. That's Nation Star. There are quite a few. Nation Star. I don't know if it's Soteris, LLS. We have a list, but there were like 3 or 4 lenders that we're having to resubmit packages to because they're not being submitted under the right field now.
So, so Bruce, I'm going to just pop in really quickly under 12 CFR Part 1024 Supplement 1, Comment 41D2. If the trial or permanent loan modification is denied because of a net present value calculation, the servicer has to provide the borrower with the inputs used in the net present value calculation.
Oh, good. Okay. Good. We should send that to Sergio right away. And good. That's perfect. So what else are you seeing, Matthew?
So someone said that they had a modification from Auckland like the one that Linda had described, but the amortization does not work out. Do you think the CFPB could get involved?
I mean, I think the answer is yes. I wonder what that means, amortization did not work out. Well,
so I think that the clarification is, are you saying that the amortization is incorrect on the truth in lending form?
It means that they have a huge balloon. Yes, incorrect.
So there's some. So there, I think that would definitely be a CFPB complaint because there are some TILA regulations, Truth in Lending Act regulations, around providing a correct amortization schedule. And not being a lawyer, I don't know what they all are, but I would complain about it.
All right, they said thank you. Ellie, while you're there, if you could just repeat the code that you cited, 12 CFR.
oh, we could send that out. We're not going through the code.
Okay,
Yeah.
I was going to type it into the chat box.
Yeah, but
It's easily, it's page 38 of the CFPB mortgage servicing guidelines.
Okay, that's probably easier for folks to find.
Yeah, and you know, it's the one that is the Help for Struggling Borrowers, a Guide to the Mortgage Servicing Rules, page 38.
I don't know if anyone can answer this, but the question is, has there been a high level of complaints submitted to CFPB with the end of HAMP?
I haven't seen the latest CFPB consumer complaint report, so don't know about that.
I do know that there were, you know, quite a few complaints filed in 2016, and you know, there were, of course, complaints filed in January. I don't know if they're related to issues around HAMP going away or just general issues.
All right. Very big picture. Someone said they heard a rumor that the president is going to try to get rid of CFPB and Dodd-Frank. Is that correct? Does anyone want to comment on that?
Well, there has been a push to end Dodd-Frank, and there's been a push to either water down or dismantle the CFPB. It's part of the political process, and so it's we're a long way off from what that means and what actually will happen, but that's definitely part of the debate that's happening in D.C. right now.
Oh, and I'll just mention, Republicans have introduced specific legislation that would roll back parts of Dodd-Frank and change CFPB dramatically, either by making it a commission or by making it have to go through the regular appropriations process. But those kinds of things are would need 60 votes in the Senate. So without Democratic support, those are things that they can block. Okay, I think that's all for questions and comments on this. Someone just jumped in. Someone said I had both my HLP at Hope Loanport, which were submitted before the December deadline, but closed out in Hope Loanport within a week of submission, and the homeowner was sent a streamline modification. Both were Fannie Mae. Does anyone want to comment on that?
Well, they need to be considered for HAMP. They don't have to be doesn't necessarily get a HAMP loan. It's an interesting question, though, that streamlines happen automatically. Is the HAMP application still active after a streamline has been sent? I bet it is. And what do the experts say?
Well, what my understanding about the streamline is that if you accept a streamline, you still have the opportunity to apply for a HAMP modification. So what I'm wondering is that streamline, is it a HAMP streamline or is it a now new FlexMod streamline?
And just to clarify, they're a little more detailed. They say they closed out the HAMP request. They didn't even review it for HAMP. So that.
Man, well, I think you might still be able to call Treasury about that. God, so what happened to the Treasury complaint lines? Are they still up? Yes, I should know this, and I have no idea.
I don't either.
I don't either.
And they also added they pushed back to Fannie, and they said, oh, well.
Well, we actually, we could escalate that with Fannie. That's the issue. That's interesting. So, and your feeling is that I assume that the client would do better under a HAMP mod than under the streamlined. We'll get into the ins and outs of streamlined shortly on this call, but or actually FlexMod, but so FlexMod is not actually really in place. They won't start closing the first FlexMods until next month, and servicers have until I think October to implement it. So some will start right away, and some will phase it in over time. So they, we probably aren't going to see a lot of FlexMods immediately. Well, actually, what we'll see is early on, those servicers that want to get out of the want to move quickly will be able to make offers to anybody who's 90 days late or greater.
Someone with a comment said, I've been using the HAMP application and it has been accepted. I've submitted 5 modification requests since the beginning of the year and no problems as yet.
You accepted as a HAMP?
I took it as they were just using the HAMP application to submit it to.
Oh, right. Yeah. So that's, I think, what we're hearing is that some servicers are still using the RMA, and others are saying, no, you can't use those anymore. So we're seeing a mixed bag on that.
So just a couple real quick questions. I don't know if anyone has the answer to this, but does anyone know how many people in CFPB, how many CFPB staff there are handling complaints? Not enough, I think, is the answer.
Okay.
Do we have any data on mortgage resets, i.e. HELOCs, HAMP, and ARM loans?
I think that's a broad question. I mean, the question is sort of how many there are total around the country, is there a time period, how many are resetting right now, those sorts of things. Treasury did do a good job. Well, actually, the OCC, I guess, is the one who puts out a good report now on these. So that information is accessible, or at least to the regulated institutions. Oh, that's a good point.
Just one last comment. This person is saying that they submitted documentation for HAMP before the program ended, now getting requests from the servicer that they need to submit their own RMA forms for those clients. Is there anything to be done there?
Well, so I mean, I think we want to make sure that the HAMP application is still in place, but this is the messy world we're in now, where servicers have the right to can use their own proprietary forms. So for the non-HAMP resolutions, those will be in play. Those, they can use their own forms. That's the problem.
Yes, it's going to be a little bit of the wild, wild west.
Right.
Definitely.
So let's move on to just talk a little bit about FlexMod and where things are at right now. So FlexMod is not started officially, but we have had some early, an ability to make an early evaluation. And just to review, and we've talked about this on the call before, there was this excellent study, which many of you contributed cases to. Thank you very much. That NCLR, Empire Justice Center, and NHRC did together. And the idea was we got you all to submit cases of modifications that were done, and so we knew that, and these were all affordability modifications. They were based on the income of the homeowner, and they got a modification, and we knew these are NPV positive or HAMP NPV positive. So these are ones that essentially, if you foreclosed on them, it would cost the investor more than if they modified the loan. So that's the good news. And then so the idea was that let's run those cases in through the FlexMod machine. So originally when we did the study, we ran through a model that Ellie and her co-workers at Empire Justice Center had worked out that was meant to replicate as close as we could the MBA model. It was a complicated model, so we're trying to catch every bell and whistle, but get us in the ballpark. And then we presented that information to Fannie, Freddie, and FHFA, and they came back with some summary documents that showed that, hey, this is actually pretty good. On the average, we do okay in many cases. But sort of one thing that jumped out at me was that we had 89 cases in the population, and 14 of those cases were deemed ineligible. And the question was, why would they be ineligible? And they said, well, because the FlexMod model would not give people a lower mortgage payment. So you run it through the model, you extend out, and what FlexMod, of course, is you amortize the whatever the unpaid balance is and extend out for 40 years. And in that model, this population of 16% of the population would end up with a higher payment, and sometimes substantially higher, it turns out. So that was pretty shocking. You have 16% complete fail rates. That was really a deep concern. But when we met with Fannie and Freddie and FHFA, we also asked, well, listen, the question is not how does it perform on the average, but how does it perform on each individual loan? And if all the FlexMods are within $4 or $5 of the same payment, that's terrific, and you're like right on the money. But if it's way off, then we need to figure out if, in fact, this is working well. So just a week ago, they came back with the final numbers on Friday. After a couple months, I'm not sure why it took so long, but and the numbers were pretty bad. So if you look at the population, so it's 89 cases that we were able to use. These are all, again, either got a HAMP or a non-HAMP mod in the last couple of years, and they were, and they all got payment reductions. They all were affordable under the kind of rubrics of the mods that they had, so based on income. So what we found was roughly 40% of the cases were not ended up with a higher payment. But some of those, the higher payment was a difference of $5 or $10, so not a big deal. People can manage that. That's I would say, pretty much on target. However, it turned out that 34% of the cases, so over a third, people would be paying at least $50 a month more. And most of those, 28% of the total, would be paying $100 a month or more. Some of them were off by hundreds of dollars, and real affordability challenges. So that was my first cut on the data. And Ellie, you had some thoughts about this as well. So why don't you lay out what you think about this?
So I'll comment about the people who were not going to be eligible for a flex mod and say that that was evenly broken among the different income levels. So it affected all the income levels equally. And another thing that's notable about the people who were denied and not eligible for, who would be denied and not eligible for a flex mod, they were all of them except for two people who had 80% or below loan to value on their property. So these are people with equity. Those are the people who were denied. Only two of them had equity levels that were above 80% loan to value. So people who had less equity. And I think that part of the problem then is presented in the fact that they, under the flex mod, if you have 80% or lower loan to value, which means you have a decent amount of equity in your property, your interest rate will not change. It's whatever it was at the when you took out your mortgage. So if you had an interest rate of 8.85%, for instance, that's the interest rate that they work the mod on. They will only lower the interest rate to the current market rate if you're above 80% loan to value. So just putting that out there. And it, again, just to be clear, it affected all income levels equally. But some other things that I really pulled out of this, I looked at the very low and low income folks in the list to see how they were affected. Because 34% of our sample was either very low or low income. And those are the people that currently, they're the ones we're seeing most often. I mean, in my world anyway, it's the very low and low income. Granted, there's a lot of moderate and high income people that we're seeing, but the very low and low income are the ones that are the hardest to get modifications for and to get affordability for. 16% of those who were low and very low were ineligible for the flex mod, so no help for them. And by the way, they were all people who had equity in their property. 35% of the very low and low income people would see a higher payment with the flex modification as compared to their original modification. And of those, 45% of them were non-HAMP mods. So this was worse even than a non-HAMP mod for 35% of the people. For 64% of the people who were low or very low, they had that had an increase in their payment. That increase was more than $200 over what their other modification was. So I feel like this is a really big argument for why we need to convince Fannie and Freddie to have an exception process, and that housing counselors really need to be included in that.
So that's the kind of, I think this is a huge gap in the program, but it does create an opportunity for us to make the argument that what we need is access to the exception process. So there's an existing exception process that servicers have where they can go outside of the typical rules that Fannie and Freddie use to add extra steps to for kind of common sense resolutions. So one of which could be an interest rate reduction, and there may be other ways to think about this as well. And the idea would be that we identify a few triggers, and those people get sent to counseling, and we have access to the exception process, and then those people we work with, and some of them are going to look at the case and we're going to say, oh, well, you know, you actually do better under flex mod, you just stick with it. And some of them we're going to say, oh no, we really need to do some extra things, and these are what they are. and then also to have Fannie and Freddie pay for that activity when they send the cases to us. And the idea would be that it creates a bigger flow of business so that fee-for-service actually works for those counseling agencies that do it, and that it really help people who need it the most. And I will say that, as probably all people have gotten used to me, I'm very pro LMI, low and moderate income, as being the focus of our work. But I really do think that there's no reason to foreclose on or force people out of their houses who are upper income, and if there's an affordable modification available to them. And we've got to kind of argue for across the board and service across the board for this population, because at the end of the day, some of these people in the moderate and even upper income brackets may be really financially damaged and end up in much, much worse shape than they would have been otherwise. So, you know, while it's, I think the number's actually pretty shocking to me. I think we have to convince FHFA and Fannie and Freddie that they're shocking. But if it were going to proceed the way it is now, we would see a dramatic drop in affordable modifications. Now, it's important to understand that some people do way better. So, so the just under 60% who got a modification that would be a deeper mod than under HAMP. You know, the term is being extended. It's a little bit more. It's certainly a more expensive loan than what you would have gotten if you'd gotten a HAMP modification, because it really relies just on term extension. But at least on the monthly payment side, some people could do well, and some people did quite a lot better. And it's because it's really, you know, it's an axe. It's not a surgical tool. It's not very precise. And so we're glad that some people do better in terms of the pricing, but the fact that a third of them do so would end up with a substantially less affordable modification is just, you know, I think crazy and unacceptable.
So I'll just add one little thing to that. That again, the people who do the best with this model are from across the income levels. It's all income levels who can benefit from this. But some characteristics that seem to be similar are that their original mortgage interest rate was lower, so it was, you know, below 5% for the most part, and for the most part, their loan-to-market values, their LTVs, were above 90%. So it's people who don't have equity and have a low interest rate who seem to do the best with the Flex Mod.
Fascinating. So Matthew.
I didn't entirely catch Ellie's point, but I think it may be the point that someone was making in a comment, which is it appears that there's two sets of processes in their experience, one for those with equity in the property and another for those without equity. And then, sorry, go ahead, Ellie.
I was just going to say that's right. If you have equity, your interest rate will not change. So even if the market rate right now, at the time that you're trying to get your modification, is lower than what your original interest rate was, they keep the original interest rate. Whereas if you're above 80% loan to value, meaning you have less equity, they will lower your interest rate to the current rate if it's lower than your original one. So yes, it's different. It's also, by the way, different if you're less than 90 days late, you can come in and apply. If you're after 90 days late, it's a streamlined offer.
And the application gives you a small, modest benefit. There's a small degree to which it's tied to income, but it's a small impact to this whole thing. So Matthew, more comments that you got in the pile?
Just one question. Someone asked if there's a Flex Mod option for non-Fannie Mae loans. So if you could just go over what how it works exactly.
Good question. So this is specific only to Fannie and Freddie. Now, what we're concerned about is that this will get adopted in the rest of the, in more of the private label security world, because what Fannie and Freddie do often is a market leader. It would not be adopted in FHA, but or VA, but in the private label securities, then portfolio lenders could potentially do it. One very interesting piece in all this is talking with lenders. When you talk to them about what they do in their portfolios, they are doing income-based modifications. They're not using, they say they can use Streamlined as a tool, but they will do a full income check on people before they offer them a mod. So where it's their own money, you know, they want to go to the route of the income. Good.
And
well,
the Mortgage Bankers Association did put forward the one mod, which is very similar to the Flex mod. It does have one small difference in it's that loan-to-value issue. They don't base the change in interest rate on the loan-to-value. No matter what your loan-to-value is, they'll give you the lower of your original interest rate or the current interest rate, whichever is lower.
Okay. Well, thank you, everybody, for a good round on all this. Quick reminder, be sure to join NHRC if you haven't already, and we've had actually a great month last month in terms of groups renewing. So, and we had a bunch of new members. I think we highlighted that last time. You know, this is the kind of support we need, and we'll continue doing our work in the field, and there's a lot more to come this year. We're going to do a lot of work around innovation and programs that your groups can use around the country to create new business lines and opportunities. So excellent. Thank you, everybody, for your good work. Please inform us if there are examples of problems you're seeing in the field on the delinquency side. This is the kind of stuff we want to elevate, and this will be a continuing conversation. So until our next call in March, we'll be in touch. Bye.